Welcome to the Just Word Podcast. I'm Pat Bolland. The Just Word Podcast is brought to you by Justwealth, investing the way it should be, just for you. You know, it's been a tough year in the stock markets overall. So let's get to an expert. James Gauthier is the Chief Investment Officer at Justwealth Financial, and he joins us right after this. James, happy summer. Great to see you again.
Thanks, Pat. Great to see you too.
Okay, I indicated in the introduction that it's been a tough year for the markets overall. How tough?
Pretty tough. I mean, it's been, in the magnitude of market sell-offs that we've seen, we're not at all-time worst yet, not even close, but it's bad enough that we're considered to be in bear market territory. So a drop of more than 20% in the equity markets. Different equity markets perform. Some are better, some are worse. But overall, equity markets globally are down more than 20%. Bonds are down at the same time. So it's kind of a double whammy. There has really been no place to hide. So when you have that kind of start to the year, it can be discouraging for a lot of investors.
Yeah, no kidding. Okay. Then if you had to break it down, is there an investment class that has done better than the others, for instance?
Well, within the broader economy, I mean, the energy sector has done very well. If you put all your eggs into the energy basket, that's being a little risky, but it would have paid off very handsomely so far year to date. And the fact that has to do with, a lot of the supply chain problems that we're seeing, the price of oil, you see it at the pumps. It's all a result of the economic environment that we're in. And energy is about the only thing that's kind of gone up. So all other sectors in the markets are pretty much down. Alternatives are down. Bonds are down. So energy is really the only bright spot so far.
It's interesting. You say bonds are down. That's not typically what happens, aren't they? Bonds are considered a safe haven, aren't they?
Well, I wouldn't say necessarily bonds are a safe haven. They're a less risky asset class for sure when you compare them to equities. But generally speaking, I mean, bonds have risks as well. So when interest rates go up, bond prices go down. So that's the environment that we're in right now. Interest rates are on the rise. It's been priced into markets leading up to the central bank moves that we've seen so far multiple times this year. So there's no free lunch. I mean, bonds are not a guaranteed moneymaker. They continually pay interest, which is great. So you're always getting income from bonds. But when interest rates go up, bond prices are going to go down. So when you come off of all-time lows in interest rates, there's only one direction you can go, and it's not going to work out in favor of the bond investor.
Okay, so then, you're a portfolio manager. You run all the stuff at Justwealth. They're all different mixes, if you will, out there. How did you manage through all those declines? How did you do it?
Well, there's not much you can do. The markets are going to do what the markets are going to do. It's not something that you can control. What we try to do is we try to address risk with each individual client, and we're proactive in how we manage our assets. So we plan for ups and downs in the markets because it's inevitable that they're going to occur. Markets just don't go straight up forever. It's not that easy. So if you plan knowing at some point markets are going to go down, it's a lot easier to manage through it. The problem that you get sucked into, many people get sucked into it, including professionals, is trying to react to market conditions. So, you think you have to move here, you have to move there. Markets are moving all the time. So if you're continually trying to chase things, you're going to make mistakes and, lose sight of what the purpose of investing is. So taking that proactive approach with clients, anticipating that there are going to be times when it's not that fun, but persevering through that, that's the way that we like to approach it.
It's interesting. Your point is well made that the stocks had had a really good run of late, and the bond market, you anticipated higher interest rates would eventually come. But by the same token, people were talking about a recession happening, and that's why the stock market fell off. We haven't seen a recession yet. At least I don't think the recent numbers indicate you have to have 2 quarters in a row of negative growth, and we haven't had that yet.
Technically, that's the definition, yeah.
Right. So then why did the markets go down so hard and so fast?
Well, the market is supposed to be forward-looking. So market takes into account future events. I mean, the market is the discount of future profits that are going to be paid back to their owners. That's the definition. That's how stocks are priced. So when it's well known that inflation is running at very high levels, what people start doing is expecting that central banks are going to raise interest rates in the future, which they have. But I mean, these fears go back to late 2021. People were starting to fear rising interest rates, and central banks do that to try to cool down economies. Economies get too hot, and that pushes the prices of everything up. There's just too much money chasing too few goods. So they try to slow the economy down to bring price pressure down. When they do that, though, the flip side is it's going to be worse economic environment and potentially recession. So it's the goal of the central banks to try and coordinate or be the architect of a soft landing. So something smooth, so there's not a big jump from robust economic growth to a bust. Basically, you go from boom to bust. They don't want that to happen, but it's tricky. And with inflation being persistent for so long, highest levels we've seen in 40 years, central banks have been aggressive in raising their interest rates, and that's leading people to think a recession is coming. And that's what's priced into the markets now.
Okay, so the question is, have they been too aggressive with interest rates, number one, or were they slack before in not raising interest rates earlier? And don't throw any politics into
it. No, never. It's fair to say that the central banks were slow to react. I mean, going back to 2020, central banks took emergency actions to try and offset the impacts of COVID. And how that was going to impact the economies globally. So there was really a globally coordinated movement to bring interest rates down to zero everywhere, or thereabouts. So that was done, and COVID still hasn't gone away. So I think a lot of central banks or the governors responsible for making decisions have been reluctant, or maybe they didn't believe that the initial readings on inflation were going to be long lasting. In fact, they called them transitory initially, which was now in hindsight a mistake. So central banks have been slow to get on this, and that's maybe they're making up for lost ground now with these large increases that they're making, 50 basis points, 75 basis points. Those are extreme measures that haven't been done too often in the past. So they're trying to play catch up.
Okay, and I get why COVID threw a monkey wrench into their planning. And they responded, and maybe, as you say, we're a little slow to, but then you throw in geopolitics, you throw in Russia and Ukraine in that situation. I mean, the central banks obviously could not have seen that coming, and still they're raising interest rates in face of that geopolitics.
Yeah, that's how bad inflation is. Because normally, I mean, if you had a shock, a geopolitical shock like a war, that's negative for the economies. So government central banks would tend to be a little more on the supportive side, but they're still going, fully in tightening mode, which tells you how bad the inflation problem is.
Okay, so then how can you hedge inflation? People in the past have talked about gold, for instance, but I don't think it's given the protection people thought it would.
No, well, in past cycles it has. Gold typically performs well when equity markets go down. There's an inverse correlation in those unique environments, but it hasn't worked so far this year. I mean, gold is down as well. It's not down as much as equity. It's down marginally. So you could have lost less by investing in gold. But generally speaking, I mean, gold is not a really productive asset. It's not like other financial assets that create wealth. Gold is sometimes thought as a diversifier. And to the extent that it might help out during down periods, that's great. There's a purpose for it, but that really is a very small amount of time. Markets don't tend to go down for prolonged periods of time. They tend to drop quickly and rise slowly. So there's really not that much of a benefit to owning gold. In the long run, gold is going to underperform the equity indexes, or even bonds for that matter. So owning it's almost like having insurance for down periods, but it comes at a cost.
Yeah. Okay, then we began the discussion about talking about the markets, and you talked about the energy sector in particular. What are your thoughts on oil and we've seen skyrocketing gasoline prices, for instance. You go to fill up your car and it costs you twice as much as it used to cost you. And that's in part, I guess, why the oil sector has done so well. The energy sector has done so well. But I mean, is it becoming an inflation hedge, do you think?
Well, it's a form of hedging, I guess. It's again, like I mentioned earlier, if you're investing exclusively in energy, that's a very risky proposition. Energy
Yeah.
is it's a volatile asset class. It's doing well now, and that's great, but it can underperform by a lot in other periods. So it's a risky proposition. It's not a direct hedge per se. Like if you buy, you know, an energy ETF as a supplement to the rest of your portfolio, and energy prices go up, and gas prices go up at the same time, that's kind of an offset. But to try and measure that and make it a 1-to-1 ratio, that's very difficult to predict. So it's not really a practical hedge in any sense.
Okay. But as you just pointed out, markets tend to fall quickly and rise slowly. The question is it time to buy now because they've already declined, or wait, hold your powder, maybe sell something until they get to lower levels?
Well, going back to my earlier points about trying to be proactive, if you're making guesses on what to do immediately, buy, sell, or hold, what you're doing is you're focusing on the short term. You're speculating, and we try to avoid that, playing that game. I would say what you want to do is stick to what you know is going to work, and that's planning for the long term, planning for ups and downs, and sticking to it. When you start reacting by buying or selling on a gut feeling, you're going to get into trouble because you become a trader and not an investor.
Okay, yeah, so that's what some people would call market timing.
It's
What kind
exactly
of
market timing. Yes.
what kind of a time horizon do you take typically? I mean, you're right. On a year-to-year basis, things can swing wildly, but I mean, what is the proper timeline?
Yeah, it's different for everybody. I mean, everybody has a unique individual situation, and we try to address them one by one. And not everybody has a long-term time horizon. We respect that, and so we would say, somebody in that position should not take a lot of risk in their portfolio. So over the year-to-date period, I've had lots of clients contact me. What's going on with the markets? Why is everything going down? And what should I be doing? So anyone that has the long-term time frame, I say you should do nothing differently than what you were doing already. Stick exactly to what you were doing. Do not react. Do not change the pattern. Do not pull money out. Do not put a bunch of additional money in. Stick to your plan, and it will work out as these short-term, fluctuations kind of go away. But for those that have short-term timeframes, we'll address them one by one. So, one particular person I can remember was contacting me. He had a house payment due in 6 months, and he was invested very conservatively. But like I said, bonds are down, which is your conservative investment. So, I told him to take all his money out now. Don't wait for another 6 months and hope it comes back. Do the prudent thing. Take your money out of the market, remove the uncertainty, and those are the types of decisions that we make for clients.
Yeah, I wonder though if there are sectors that are a little bit safer. And I'm talking now about preferred shares, so they pay out dividend stocks for that matter, whether that's banks or life insurance companies or anything along those. Even I don't know, real estate as an investment. Although I got to point out, real estate's pretty volatile as well. What are your thoughts?
Well, I'd say of all those different asset classes that you mentioned, real estate probably has the dimmest near-term prospects.
Mm,
Again, with interest rates going up, that means mortgage rates are going up as well. Things become a lot less affordable. And we've already seen market prices come down, market activity come down. The outlook for real estate, I would be a little concerned if I was to be a seller in the near term. Um, Again, that's speculation, so take it for what it's worth. But
mhm.
generally speaking, the other asset classes, I don't think there's anything that's more safe. Everything has risk, and the long-term risks associated with bonds tends to be lower than equities. Preferred shares, they're somewhere in the middle. The short term, who knows what's going to happen? But in the long term, you can kind of gauge that risk level based on the long-term performance histories. So bonds are the least volatile, preferred equity and higher yield bonds are kind of somewhere in the middle, and then equities are at the other extreme. So there's always going to be a risk. No sector is ever safe.
Right. But people have traditionally said invest in companies that pay dividends, for instance, not necessarily preferred shares, but companies that pay dividends, because at some point the dividends give you a cushion, right? Or wrong?
Well, what I'd say is it's different. It's diversification because you have a combination. So typically dividend paying companies are more stable, they're more mature, they're profitable, which is great to have, but they don't have much upside potential. So these kinds of companies are going to come in and out of favor over time. They might be a little more stable in down periods, but in up periods where people want growth, they're going to be going after the high tech companies, the ones that might not have profits now, but are going through rapid growth and have lots of promise for the future. So everything is cyclical and things are going to come in and out of favor. But over the long term, they're going to be much more predictable in terms of what they're going to return.
Right. So your message, James, overall, stick to your plan.
That is always the message, yes.
James, great to chat.
Good to see you again, Pat.
Okay, James Gauthier, Chief Investment Officer, Justwealth Financial.